Hey traders, it's Victoria from TRADEPRO Academy. Welcome back to our channel, and boy do we have a video for you. We're going to be breaking down, as you may have already seen from the title, auction market theory. Now we've talked about this a lot, but I'm going to be breaking down exactly what it is from front to finish and creating a trading strategy out of it. Now this is more of a trading philosophy rather than a trading strategy in itself, but it is one of the best tools that I have found for consistency over nearly a decade in trading, and it helps us understand where the markets are headed, directionality, and who's in control. You don't have to understand all of these different terminologies used by different other gurus that have been placing tags on specific strategies or whatever. You just have to understand how the market moves based on one individual principle, and that's volume, and that's exactly what we're going to be covering today. So if you guys are excited, stay tuned. We're going to jump onto the screen and dive right into auction market theory right after this intro. Let's dive right into this. We're going to be breaking down everything from the basics of auction market theory all the way to using it with set out profiles, the way that I use it. I'm going to show you how I interpret it and what tools I use to actually create trade plans and trade this. We're going to be understanding the market movement and philosophy throughout this. One of the main things that I mentioned before, right, and that I want to mention again is that this by itself isn't necessarily an individual trading system or strategy. It more hinges on the concept of market philosophy / how markets move based on the understanding of volume and market participants. So understanding this to a high degree can give you a very good understanding of the market directionality, the market participants, and from that start to gauge a strategy. And I'm going to be breaking down mine at the end. The philosophy of how markets move, right? It's auction market theory, AMT, is generally referred to, or maybe not as commonly, but as distribution theory, right? Distribution theory brings in the concepts of breaking down where distributions are in the market based on volume. So, like I said, it's a philosophy that plays on the concept of markets moving from balance to represent what we call fair value. The market is a constant, infinite, two-way auction that is always in search of value and fair value. Where traders deem fair value to be, that's where the price is going to rotate the most. You may have heard of fair value or intrinsic value from an investment perspective, right? Where you have analysts that think prices are cheaper or more expensive than they are for individual companies. And that similar concept is brought into trading on a more intraday / even, right, multi-day time frame, where as participants, we're trying to find, well, maybe not us, but the general market is trying to find value, right, based on the information that it takes in. So like I said, it's not necessarily a strategy by itself, but inherently learning what it means and how to gauge it can help you create a trading strategy, something that we'll talk about at the end. So this whole lesson, this whole plan is how I read markets, understand the direction, strength, and create plans from this one philosophy. So let's go through the agenda, what I'm going to be mainly talking about today. We're going to go through auction market theory, right? The main principle, what it is, what it stands for, even though we've already done a decent intro. We're going to talk about auctions, fair value, and balances. We're going to talk about auction rules, direction, acceptance, continuation, rejection. And then what we're going to do is we're going to go through the charts and the graphs that are used and how I interpret auction theory based on profiles. And from there, we're just going to dive into how we can start formulating a strategy out of this. So without further ado, let's dive right in. So auction market theory, the main principle, right? As we know, it suggests that markets move based on balances. Now, what are balances? They're generally defined as fair value. So where the majority of the volume tends to be, or the majority of the sample size tends to be. So markets also move based on balance to balance movement. And in between those balances, we have something that we call unfair value or imbalanced areas. It's the same concept as markets moving based on compressions and expansions. And the thing is, we can dictate direction more clearly with auction market theory. So the understanding of market participants and where they get active is the difference between just looking at a chart and being like, okay, we're in a range, we're probably going to go up or down. right? There's more to it when we understand the influx of market participants and how they created the moves and how they want to remain in balance or outside of balance. So, all concept of this philosophy is looking to identify where prices create imbalances to trade from. Markets generally move based on imbalance. They move from imbalances. The largest moves are based from imbalances. So, as auction market theorists, what we're trying to do is identify where markets are theoretically imbalanced so we can find these larger moves. Now, remember, compressive periods in the markets, they take up about 70 to 80% of the market movement, and the expansions, the remaining 20 to 30%. These compressive areas, as I had mentioned before, they're the balance, they're the fair value. It's where prices rotate, where prices congest, they create a lot of volume, they create a lot of moves like that swing in a range. And right, eventually there's going to be something else that comes in that creates that expansion. So looking at this from this perspective, right, how do markets move based on these balances and imbalances? So markets are continuous, indefinite, two-way auction. Buyer, seller, buyer, seller, buyer, seller. What happens is that markets are going to be in a balanced area. Let's call this fair value. This is often referred to as where markets are most efficient, right? Where they have the volume that gets stacked up, where prices stay, where they rotate a lot, where they get those compressive periods. And in these scenarios, right, in these balanced areas, in these balanced markets, there's definitely no new information that enters the market. This happens about 70 to 80% of the time where no new information enters the market. You have an extreme to the top end and to the bottom end, and price just oscillates with it. There's going to be some kind of event or something might happen, whatever the case is, where markets get imbalanced. They start to move outside of this balanced area. And this is based off new information that might enter the market. It's also mainly based on imbalances from market buying and market selling, the real supply and demand. Not your supply and demand zones or that stuff. It's a real supply and demand. So, for example, there might be some kind of situation that sparks very, very heavy aggressive selling. While market's going to pull out of that auction that it's in right now, out of that fair value that it's in, and it's going to start dropping realistically. Or it's going to start dropping and it's going to expand outside of that fair value, outside of that balance. And it's going to remain in an imbalanced territory until it either finds a prior auction, a prior balance to trade into, or it might create its own. So then markets remain dormant again for an extended period of time where they rotate, no new information comes in, they get compressive. And then again, imbalance happens where maybe demand this time is much more aggressive. Market buying is coming in super aggressively. That tells us from this market buying that realistically prices would want to go up and we're going to hunt either that prior balance that we fell out of or it might create something in the middle. So this continues and continues and continues. And when we put that in our heads, right, when we understand that, we can understand the direction of the market, right? The direction of the market based on where these balances and imbalanced areas are. So that's how markets move, right, from one to the other. Now, we've talked a bit about fair value. We've talked a bit about balances, but what do they necessarily mean from a visual construct? Fair value is often referred to some kind of like Gauss curve, if you will. It's a normal distribution, right? It's a bell curve, call it what you want. It's pretty much a normal distribution where the volume profile comes from, in essence, right? The volume profile is something of a normal distribution, where the majority of the data is clustered within that 70%, where 70% of the data is surrounding the mean or the peak of fair value, which is usually the point of control. So this is where we can introduce volume profiles, right? We know volume profiles to have value, right? Value areas. We know them to have clusters, right? So I'm not the biggest of fan, as you'll see a bit later, in using volume profiles where they're given notations, meaning they're given value area highs, lows, value, POC, stuff like that. I'm looking at it more from the construct of where the heaviness of volume is created. So if we say, right, because not all volume profiles are going to be the same. That's the thing. If they all look identical to this, to what we have right now, then fine, great. We could easily look at this and understand what fair value really means. So if we understand that this is the value area over here, this is where value is. This is going to be fair value in price, right? Price wants to remain in this area. When we move lower, right, where we get this expansive move, where there's clearly more sell side pressure than buy side pressure for whatever reason, we escape, we might create a new value into the lows, a new distribution before, right, the same thing happens when we enter this prior distribution to the upside. So this is a hint as to how we're looking at these directional movements and the directional changes. Markets move from balance or value to value to value to balance continuously. So we're going to be using, as you might guess, volume profiles to better understand what it is that we're looking at here. So in terms of fair value in auctions, right, we refer to balanced areas as fair value, where the market will move from one area to the next, holding that balance until it doesn't, realistically. So we don't necessarily know a lot beforehand, right, if this value is going to fail or not. However, right, understanding how prices get to that balance gives us a lot of insight that we can use in relation to holding balances and directionality. So in this way, we can also make up rules for balances that give us direction in the market. Direction is based on where price is in relation to the balance that we're facing. And markets want to remain inside of the fair value as much as they can. And this is what we call a compressive zone, where, like I said, there's no new information that enters the market. Should the new information enter the market, we get an expansion. So these extremes that create the balances are generally created by strong-handed traders. I don't mean institutions only. I just mean people who have enough size to be able to move markets. They're most active at these extremes. That's why we want to get active at these extremes, because they have the ability to put size on and move markets because it's a cutoff of volume. And this is where the push and pull of the two-way auction happens. So if we take a look at this example, right, we've got two main profiles on the right and on the left, right? And as you may have noticed, we have a value area here, for example, right? This is our value area if we look at our individual charts. Now, what I said in the prior slides is that I don't necessarily like to use that. I mainly focus on where the value is actually created, and that is the actual distribution on an individual day. So what are distributions, right? Distributions are belly-like areas that create a lot of volume, right? This is going to be what we denote as a balance, right? This is going to be a market balance realistically. So these are individual days that create their balances, right? And then we have our friends over here, which are the cumulative large profiles that we're interested in. So as you can see, right, in this perfect example here, we have two areas of very heavy volume. These are going to be our balances or our fair value, right? It's going to be our fair value in price at the moment. And over here, you can see that volume just withers away. This is where we call our imbalanced area. So if we look at this from that perspective, we have boom, one value over here, right? Then we have boom, another balance over here somewhere. So based on some of the rules of auction market theory, we do want to remain inside this balance. And eventually, if we do run outside of that balance, we're going to be looking for another balance elsewhere. So it's going to be easy for prices to escape this low volume area in seek, right, of the other balance in other areas realistically of heavy volume. So some kind of new information might have had to enter the market for prices to do this little escape. And as you might have it, right, these 2 days here were based off PPI, the inflation data that came out. So yes, there was some kind of new information that enters the market that allows for this expansive move after compression. So we're going to be diving deeper into this specific chart and other charts and how to understand the creation of these values and also directionality using auction market theory. So when we talk about auction and auction rules, there are rules based on direction, acceptance, continuation, and rejection, right, that we want to follow. This is a part of the theory that guides us closer to a rule-based strategy. So this is something that we can start employing in our trading strategy in itself. So market direction rules are based on balances that allow us to stay on side of trends and where we see that the trend might reverse and fail. These auctions, these balances, these fair values, call them what you will, they're going to be our guidelines with the rules that I'm going to break down right now to help us understand the current trend of the moves, how it will continue, and where it can fail. So first and foremost, you saw the cumulative profile in the last slide. I generally use a larger cumulative profile, the one on the right-hand side, either a 100-day or a 200-day cumulative profile, depending on the current market situation, right? If there's no volume, if we haven't traded volume in over 100 days at an area, I'll increase it to 200 days so I can get that information. So I do use individual session profiles as well, like we saw in the prior slide. And right, we're going to look at delta profiles as well, so we can locate prior balances, individual day balances that might give us a little more information. So let's look at the rules for direction. As we look at the rules for direction, I'll break each one of these down, obviously with examples. The rule number one, price that is inside of balance. Imbalance wants to remain inside of this balance, right? The extremes of set balance are to hold as resistance and support, right? That's the general thought process around these auctions. Number two, market direction can be denoted from the movement where price came from to accept the distribution, right? This sounds confusing. We'll take a look at an image. So, for example, if we move up, right, if we start at a lower price and we move up and there's a distribution above said lower price and we accept above into that higher balance, that is bullish pressure where I want to look for more continuation on the long side. Markets will stay in the current trend / direction as long as the distribution extremes hold, and the prior distribution of holds is escaped this extreme. So that's the last trick. So the tongue twister. As long as the prior distribution of holds its escaped extreme. What that means, imagine this. We've run up into a new distribution that is higher than current price, right? And now we're in that higher distribution. We want to hold the bottom band of that distribution extreme for the buy side, or, right, we can hold the top of the prior band of the distribution to continue that momentum to the upside, right? So number four, when prices move outside of balance, the ledges of that prior balance are to hold to continue that direction. And number five, imbalanced markets are to stay imbalanced, looking for prior balances or to create a new balance. So let's look at this a little more intimately, if you will, with some imagery here. Now, number one, price that is inside of a balance wants to remain inside of that balance. The extremes of that balance are to hold support resistance. So look at this image, right? We have this distribution area where we have the fair value inside and prices of our inside of said balance. And you're going to see they want to hold the extremes. So generally how price wants to move inside these areas, inside these auctions. This is a compressive period. These compressive periods, when you start to see a range, are going to create this balance, right? They're going to create this compressive zone, and we're going to fail the tops and the bottoms until we see some kind of expansion. So if we find ourselves inside of a larger balance, right? Prices open inside of a larger balance, they close within that larger balance. Prices want to remain in these levels, right? So it's very important that we understand that. It's also important to understand market closes and opens. That's another pivotal area. Market closes and opens on a day-to-day basis, right? If we are opening and closing within the balances, that suggests that prices are inside of that balance and they want to remain at the extremes to hold to continue this kind of momentum until, right, maybe we open and close outside of a balance. So next part, rule number two. Market direction can be denoted from the movement where the price came from to accept the distribution. Meaning, if we move up into a new balance, there's bullish pressure. The opposite holds true on the sell. So in this case, right, we have a bearish example where we have two auctions here. We got two values, two distributions. So at a certain point, right, prices are rotating within this balance, and there might be some kind of aggressive news that prompts the sell. That sell comes in, and maybe this is a prior balance or we're creating a new balance at this point, but prices accept into this area. How do they accept, right? How do prices generally accept? One key factor of acceptance is if we reopen the next session inside of set balance. Another factor you can use on an intraday basis, right, on the S&P, maybe around a 10 to 15 point move through the area, around 50 points on the NASDAQ, right? So we're talking about these futures. Now, if I see some downside momentum at the end of a given trading session, and the next day we're opening inside of a new balance to the downside, I'm going to look at this as a directional bias for the seller. So at this point, I think we're inclined to look for sell pressure because we failed to hold this balance. We might have failed to continue a move to the upside. And now we're rotating lower, moving into new balances or maybe old balances to the downside, which holds a bearish notation on prices And I'm going to be more inclined to sell rallies, ideally at the top bands of this new balance, of these new extremes. So number 3 kind of plays along with that. Number 3, markets will stay in the current trend / direction as long as the distribution holds its current extremes, right, based on where they came from, or prior distributions hold the escaped extremes. What does that mean? So in this case, again, right, we have rotations inside this higher balance, and what we're seeing is a move into a new balance. Maybe prices reopen the next session down here. So I'm going to be inclined to look for that sell side premise as long as the top extreme of the current distribution holds, and, right, or the last chance is the prior bottom extreme in this case, right, where prices escape from, is the last chance for that sell to come through. Otherwise, what happens if we accept back within this area of balance over here, then there is what we call a one rejection of the continuation to the trend to the downside, and 2, the reversal in the trend. So these 2 rules I want to keep very, very close to because they help me understand where the prices will continue and where prices will fail. Number 4, when prices move outside of a balance, the ledge of the prior balance is expected to hold to continue said direction. So this simple support resistance concepts, when we escape a value area and there's very thin in volume, generally speaking, if this is a real strong acceptance to the upside and escape, it's going to be very hard for the seller to accept into an area that has such heavy volume. So if the buy side's really strong, right, the sell side's super weak, we move through this low volume area that's above, and the sell side cannot penetrate this heavy volume that is back below. So we're expected to hold the top extreme of that escaped area. Now, the final rule, imbalanced markets are generally to stay imbalanced while they look for either a prior heavier balance or create a new balance. So if there's just like a strand of very thin volume to the upside, right, when we escape a distribution, let's say over here we have this distribution, then for another like 50, 60 points, there's nothing there. Realistically, it's going to be very easy for price to traverse over here. And if it's a strong momentum to the buy side, that's what happens at all-time highs generally. If it's a strong momentum to the upside where all-time highs, there's virtually nothing. There's no volume up there. What price are going to do, they're just going to rotate to create just another new balance into those highs, right, which might look like this, and, right, try to continue that momentum by accepting higher. It's not going to be a very clean move of imbalance if we just, like, come back and fail and try to accept in this area. If anything, that puts a lot of downside pressure in this market where the bears are going to be much happier and stronger and looking for a larger continuation lower. So, this is one of my favorite examples, right? This the kind of block auctions, if we imagine that both of these are 2 individual distributions, and we can assume that price is either anywhere or can come from anywhere, we can get a very good understanding of how market direction works based on distributions and auctions, and also keeping in mind the closes and openings. So how will distributions directionally accept and reject, right? We can use this little diagram to help us understand that a bit better. So let's assume that the dark areas are in the distribution of the value areas, right? You draw a crappy little volume profile over here, very crudely drawn. And the white areas surrounding are imbalanced areas. So if I assign numbers to all these areas, so number 1 is going to be this imbalanced area, right above this distribution. Number 2, right, I can assign it to the distribution. Number 3, another area that's between the 2 distributions of low volume, right? Imagine this, and then over here like this, and then obviously down here. Number 4, I'm going to assign to the next distribution. Number 5, I'm going to assign to the other low volume area. So we can play this little game. We can assume that prices can be anywhere in these areas, right? And no matter where prices are, we have an understanding of where the direction of the market is supposed to go, right? How it's going to continue and how it's going to set up. So for example, let's say that prices are in number 2 inside this distribution. This is where we open today. So we got to ask ourselves, number 1, where did we come from? Right. Well, number 1 theoretically is, are we inside of balance or outside of balance? In this case, we are inside of balance. Check. Number 2, right? Where did we come from? Because that's going to help us understand the directionality and the directional pressure of the current market. So let's say that prices came from above. Right? Prices came from above and we're about to open inside the distribution. What this tells us from a market participant perspective is that there is heavy enough selling that moves through this low volume area that it actually accepts into a heavy volume area, right? So what that tells us is that this selling is still very strong, right? There's some powerful selling going on in this area. So when we see this and prices are in here, about to open in here, we have the understanding that the bearish pressure is stronger, where I would most likely want to be selling rallies into the top band of this distribution, looking for the lows and potentially even further to the downside. So we can look at it from the other end as well, right? If prices were to reopen within this distribution, however, they came from below, right? When they come from below, it does the opposite, right? We have that bullish pressure, but we also, right, have the bullish pressure to continue outside into this imbalanced area. Or, remember from one of the rules, the final chance for the buyers is even if we pull down into the top of the prior distribution that we have escaped from, right, originally, we can still hold bullishness, right? It's a lower probability, it's not as aggressive, but we can still hold a bullish trend if we pull down away from this and into the prior one, as long as we move back within this distribution that has the potential to accept higher. The only case that the market is going to reverse is if a different distribution is exempted, right? So if I have the understanding right with the assumption that maybe price is over here, and it came from below, we look for the rotations, and I'm more inclined to buy dips into this area to see if we can rally outside into this low volume area where I expect this area to hold as well if we're really strong, and try to accept into the upper band distribution. If it's strong buying, it should do this. Now, this is the case where if we drop all the way back down inside this distribution, that's where the trend will reverse. That is what's going to cause the downside flip in these markets. That's what's going to fail the current upside trend. So directional reversals come from the acceptance of opposite distributions at balance each. If I'm to stay bullish, I want to stay bullish in the distributions higher, into imbalances higher. But the second I start breaking down and start accepting distributions lower, we can kiss that bull goodbye. And it's the same thing with the bear side. Because the bear side, all of a sudden, right, at some point, it just keeps accepting lower and lower and lower and lower. But let's say we try to move into an imbalanced area and we close back within this distribution, right? That's giving us a hint that we're starting to fail the continuation. Now, it's still bearish as long as this area holds, but if we do one of these, well, that's the trend reversal, and that's the directional reversal that I want to be a part of. So I don't want to continue selling rallies. I want to kind of displace myself in that thinking and start looking at the other side of the move. So this is a way that we can still have a bias in the markets, but not a blind bias as to where, oh, I need to sell rallies. This thing has to keep going down. If I understand where the auctions are and the distributions are and where value is and what prices are and moving in relation to value, well, then I can stay outside better. So let's dive into the charts and the graphs used. We talked about a lot of the theory. Now let's put that theory into practice. So the charts that I use, right, and these are based on Sierra charts, right? We have a link to the charts or a download in our free Discord, right? You can find it anywhere, community.tradeproacademy.com. And there are 3 general profiles that I look at. There are 2 separate charts, right? Each of them has multiple of these 3 that I look at. And first and foremost, right, the 100-day or the 200-day, which is set over here. This is going to be our best friend, right? This is going to be the main chart that we're going to be looking at to understand where value is. So depending on the most recent movement, like I said, 100-day or 200-day. 200-day because we had when I was creating this video, I started using a 200-day because we've explored some downside that we haven't seen in a very long time. So I needed some volume there. And then I'll use an individual session volume profile. I'll explain it to be the extended trading hours and the regular trading hours. The extended trading hours are the light blue figures, right? The regular are the dark blue figures in both charts. And then market profiles, delta, and volume profiles attached, right? So these guys over here, this is the market profile, this is the delta, right? You have market profile and an individual session. So let's step by step go through these so you understand exactly what it is I'm looking at. First and foremost, the 100-day profile, right? The 100-day profile is attached to an individual session profile as well as a 5-day profile. The way I use the 100-day profile over here is I'm looking for the big distributions, the big auctions to guide me. These are going to be my guides like I showed you in that example with those gray blocks, black blocks, whatever it was, to understand directionality in this market. So first and foremost, right, I got to be looking at this from the perspective of where I can find my clean areas of value. So you may know that what I'm doing right now, right, maybe we do something like this. What I'm doing right now is I'm trying to break these down in terms of where the heaviest volume is. So when I do that, what I'm doing is finding the fair value based on multiple days. I'm not looking at where the value areas are on these larger profiles. I'm not looking at where the POC is. I'm just looking at where the thickest area of volume is that I can enclose price, which is going to be my balance, right? You can see that the extremes are going to be the biggest drop-offs in volume. So if you make the mistake of making a value or a distribution larger or smaller than it is, it's not the end of the world, because these biggest drop-offs, right? I'm just trying to find the key extremes that sandwich together the most encompassing volume, right? That looks like realistically a blob. So I can say something like this, for example. I can grab this one over here and say like this one, right? I'm just looking at these key extreme ledges. I'm not trying to break every single one of these down because I'll get a bunch of like different levels, which I'd like to trade off of. But for these purposes, I'm just trying to break down the area that has the belly, right? I'm just trying to find where these bellies are because that will denote where the balance is and where the overall compressive zone is for us to trade from. So the individual session profiles, as you might have noticed, this is the exact same chart because we have these sessions. Like I said, the ETH is the lighter background, the RTH is the darker background, and these individual sessions, you'll see that they're colored, right? So you'll notice that I'm not necessarily dying over where the value area is or where the point of control is too much, but I'm looking at these to identify where there are areas that might represent balance, right? So these balanced areas on an individual basis, like this, maybe like this, can give me an understanding, right, of where these balanced regions are and where we are in relation up or down, right, within them. But mainly I'll be focusing on this, and then I'll be looking at these. These individual profiles also, they're split into colors. Might look a little rainbow and too colorful for you, but these colors serve a purpose, right? The colors are based on a percentage of volume of the point of control, meaning that the point of control is the heaviest area of volume in any given session, right? That's factual. And that's denoted by a blue color. So every point of control is going to have a blue color. It's also the white line. These obviously indicate very heavy areas of volume. Now, if I exclude the point of control, I'm looking at areas that are not the point of control with very heavy volume, right? These give me an understanding that there is a lot of activity there where it's creating a lot of value. And we know that buying and selling is very heavy in that area. That could potentially present downturns or upturns in the markets. One of the other things that I didn't mention was the 5-day profile here, because this helps me understand where the value is over the last 5 days. If I just group these areas together, and then you have this thin volume spot over here. So I know that there's a lot of value into the highs and into the lows of the last 5 sessions, right? And we've moved up to create new value into this high after creating a lot of value into the low. So it's giving us bullish momentum. Not only that, but it's confirmed, right? We have levels to trade off of as well based on that 5 day. And it gets confirmed by using this like larger profile over here, where what we can see is that what happens, right? This is exactly the situation that I was talking about earlier. So what happens in this specific situation is that prices manage to close into a distribution higher after playing around these lower distributions. This is inherently bullish. So how is it bullish, right? We try to locate where the prior distribution is. It's bullish as long as the bottom band or the top of the prior band of these balances hold support, and we can look to buy I'd rather be a buyer at the lows to see if we can get to the top and maybe higher to get that more expansive move to keep us on that bullish directionality. So there's a bit more to it. I'll talk about that towards the end in terms of creating a plan and understanding what to do with these. But this is another area over here, right, where we have the market profiles again attached to what is now Delta. Delta is the first form of order flow that I use to understand market buying and selling imbalances. So from the market profile itself, right, I can identify where we have, like I said in the past image, where we have our key balances on an individual basis to see if we start moving up, we're going to be bullish, for example, in this case. But we also have Delta. Delta is at the ask trading minus at the bid trading, right? Heavy market buying minus heavy market selling. That creates blue or red delta. So at the ask, if we have 1,000 lots that come in, and at the bid we have 500, we'll have positive 500 lots, which are going to be denoted by these blue deltas. So delta helps me engage directionality as well, because heavy areas of balance with a lot of delta can tell me if traders are trapped into the lows. With all this red delta, they're trapped into the lows, which gives me the indication of some more upside in this market where I want to be looking to buy some of these dips or the continuation of this trend that's newly accepted a distribution to the upside. So I've made a lot of videos on Delta. You can go check those out. Now, this is another tool that we can use in engaging our auctions and our market activity. So how can we interpret auction theory based on the profiles? Now, I've already given you guys a sneak peek of this. We just talked about it, but let's do a deeper dive into it. So step number one, what I'm going to be doing is I'm going to be identifying the large auctions based on my 100 or 200 day profile. So we have this auction over here. We have another auction lower that starts over here. I draw the auctions based on the heaviest dropouts and where I can visualize that there is a big area of volume that's clustered. So for example, this one's a little smaller, but it works as well. And then there's a start of a new one above over here. So we can draw that one as well. So that's step number one. I want to identify what's going on from that perspective. Step number two, I have to ask myself, remember, where am I? Am I inside of a balance, or am I in an imbalanced area where volume is pretty thin and pretty low? So in this case, right, leading up to this move, starting over here, we are inside of a balanced area after moving above, right? So that's putting bullish pressure where I want to buy the bottom band of this balance or the top of the prior balance, which is the last chance for the buyers to sustain. And we're going to see the potential for some upside momentum. Now, not only that, but these individual profiles can give you some kind of understanding as well. So when I'm looking at these individual profiles, I can see that there is general value over here, right? There's general value at this area. And you can see that the heaviest volume denoted by green and blue is slowly stair-stepping higher. What that means is they're creating heavier volumes, higher and higher, higher lows, higher highs, higher lows, higher highs, so this heavy volume, which gives us an instance and identification of more bullish pressure. And I can look at these balances, and these balances realistically are trying to hold higher and higher and higher on any given individual day. So I can take this information and say, okay, well, if I start my session over here, and I say, you know what, well, it's still bullish as long as we hold these two areas. So I can be long from here or here. And we get to move up the next day. This is the overnight session. What does the overnight do? The overnight opens somewhere within the distribution. So I can look at the prior day, or I can look at where there's little ledges of drop-offs on the larger distribution. The prior day, over here from this overnight, right, we have the balance that starts over here. And we have this like low volume area and the bottom band of that support. So I can either be long here or down here to see if we can continue that momentum. Otherwise, we're going to trade a bottom band of this distribution, where this heavy volume is or where the low volume drops off. So we get a nice little push, and then this is the new overnight session. The new overnight session, what it tells me is that there is very, very heavy volume that's clustering into the highs, right, as well as into the lows. So we're very close to the top band of this distribution. We have a heavy, heavy volume area, balance area up here. So I got two options. We either pull down so I can buy this balance, or if we start moving above, I can buy the tops of this balance. And eventually, what does price do? Price cracks this larger distribution, moves up into an imbalanced territory. I want to be a buyer above here. I'm directionally biased to the buy side continuously. This day closes inside an imbalanced area outside of this prior imbalance, more bullishness through this minor area of distribution. What happens? It creates heavy value and volume at these highs. So the ledge, the bottom of that area, right over here, is a very important support to continue this upside momentum. Otherwise, we'll trade down here or somewhere here. So I want to be a buyer at the extreme of that low. So this is a low of this day. Now I want to continue that momentum. So now it's imperative. Can we move into this distribution higher and accept the new balance? Or, right, I'm still bullish at these areas or at these areas. So based on that, let's take a look at what happened on these days. So if I'm looking at this day, starting from here, right, is this individual day. So I said at the bottom of this region over here, I want to be bullish where this value drops off. That's like pretty much the last chance. Otherwise, we're going to explore lower. So there are some opportunities where people are pretty active here, right? Maybe you can try the longs, right? Maybe you can try the longs over here. But we know that we need to be getting along above these areas once we start moving back above this prior value over here, right? So we can use some of these other extreme ledges on the profiles to help us get along, like over here, right, at the ledge of the prior distribution. Higher, we kind of failed, but we're still holding bullishness. We're still holding the areas of heavy volume. So what does that look like on Delta as well? Delta is going to give us a little more information. So look at this. If we look at a 100-day profile, the bottom band is somewhere over here where the lows. Now, Delta, right, on this individual day, we have a lot of at the bid trading, right? Market sellers getting aggressive at lows that can't do anything. Market buyers are trying to hold price. They keep trying to sell into these lows to no avail. These are trapped sellers at this area. So as long as these trapped sellers hold, I can be bullish in this market, and I want to buy where these people are trapped at the bottom of the new auction that we've accepted. So these are these areas right here. I want to be a buyer to continue that next momentum push to the upside. Otherwise, right, we pull lower and we look at where the other imbalanced areas are, right, where there's a lot of volume over here at buy side, the start of an E distribution. Right? As long as we can hold that, we're still good. So what we've done over the past multiple slides here is we've actually started to create a trade plan. So with these auctions, understanding how the auctions work and how the movement works, where the distributions are, where value is, how the individual sessions create volume and Delta creates volume, we can put all this together to create a trade plan as to where we want to trade and what direction we want to trade in. And I've created a lot of videos on Delta and other aspects that we just covered here. So if you want a little more information, you can go check this out. But in terms of auction market theory, these are the basics to the more advanced steps where you can start culminating these aspects and this philosophy to create a trading strategy. Some of the additional information to wrap this up. Auction market theory, like I said, it's a philosophy, right? And throughout this, what I've broken down is how to use that information to start turning it into an actual trading strategy. Now, many traders can just use our auction market theory along with some other nuances, but I also like to add order flow to help me get a better image of things, like the strength, right, the areas to actually execute, and more. So you saw the Delta profile. That's step number one in understanding the nuances of imbalances from order flow. Then you can also look at the depth of market. Again, a lot of videos on that, and the footprint to 10-point areas that you actually want to execute in. So for example, if I'm looking at the footprint or even the DOM over here, the depth of market has a lot of positive delta into these areas. So I have a few areas that I want to see market buyers step in so I can get long. If I look at the delta on the footprint, right, I come down into the 63 area. So somewhere over here, 64, 63, where this massive buy delta is, where we're littered with a lot of buying. So this one sticks out a lot in comparison. So over here, right, we want to see, okay, sellers get trapped numerous times. These are our longs, realistically. and we can look to continue that momentum higher. That's just a very quick example. So with all this information, you can start understanding the philosophy of auction market theory and starting to add your twist and nuances to create some kind of trading strategy. So I'll be sharing this trading strategy with you all with newer videos when I make those videos, and you'll see how to combine all of this along with order flow and execution. So if you enjoyed this video, remember, hit that like button, drop a comment down below, and let me know what else you want to see. I'll see you all again next time here at TRADEPRO Academy, and I hope you thoroughly enjoyed this video and learned a lot from it. So thank you and take care.